This stock is the only solar stock you need, and it just so happens that it's an incredibly great buy right now, and here is why. The stock I'm talking about is Canadian Solar, and bear with me because it's just insane to me how it isn't trading higher. Firstly, we'll compare it to other solar stocks, then look for its financials, and finally go over its business plan. So Canadian Solar's trailing price to earnings ratio is 4.59. Now this metric doesn't necessarily tell you a lot on its own, but it's very useful for comparison with other stocks in the same sector. And if we take a look at other well-known solar stocks like Enphase, SunPower, SolarEdge and First Solar, we can see that Canadian Solar has the lowest PE ratio among them, and quite a lot lower for that matter, because the stocks I just mentioned have PE ratios between 20 and 40, meanwhile Canadian Solar is just 4.6. A lower PE ratio means that the stock is either undervalued or the market doesn't think it has the same growth potential as other stocks. But next, just take a look at its market cap. It's just $1.4 billion, while its book value is around $2.3 billion. And this is the only stock among other solar stocks with a market cap lower than its book value. And with that, I would like to point out that Canadian Solar's price to book ratio is just 0.59, while other stocks, especially Enphase, have it a lot higher, which is another reason why Canadian Solar might be undervalued, or at least Enphase overvalued. Now onto financials. The company's profit margin is around 4% and its return on equity 16%, which is great, but it could be better. It's also great that the stock's revenue per share is 121, that its book value per share is $37.78, which is almost twice its current stock price, and the fact that the company has $1.9 billion in total cash. But it's not so great that it has $3.3 billion of debt, a very high debt to equity ratio, and that its quarterly revenue and earnings growth have been decreasing. Now, if I only saw these numbers, I would never buy the stock, but when we consider the fact that other solar stocks, except for First Solar, have the same numbers if not worse, Canadian Solar starts looking more and more undervalued. Now, the company has two business segments, Recurrent Energy and CSI Solar. The latter makes solar modules and battery storage solutions, meanwhile Recurrent Energy is one of the world's largest clean energy project development platforms, and this is what I think makes this stock an even greater buy. Because in the latest earnings report they stated that they are changing their strategy. In the past they were building and developing these projects, solar farms, just to sell them. But now they're going to retain greater ownership of projects, meaning that as time goes on, the company will have more and more solar power plants, which will generate higher and higher stable income. Now that we have covered that, let's go over what happened in the past 2 months and what trades I've made. So yeah, if you're new, this is the 26th episode of my investing series, in which I'm trying to build a $100,000 stocks portfolio, so yeah, we have a long way to go. But first, let me just say that I had to delete previous episodes because of some YouTube issues, but I've solved them, so this and all the next episodes are here to stay. So yeah, the trades. On December the 14th I sold Foot Locker, CBRE Group and Tikvia for a small profit and bought more of Quantum Computing and Rigetti Computing, which are just two quantum computing stocks. As for these stocks I sold, they are the leftover from my experiment, so just ignore any stock that is worth around $5 to $8 because I'm selling them as soon as they become profitable to buy stocks I actually want to invest in. And I did the same thing on December the 21st to buy D-Wave Quantum. And with that we've came to January 19. That is when I sold my whole stake in Shockwave Medical for a decent profit of $17, around 17%. And this is one of the stocks I actually wanted to invest in and hold for a bit longer. The stock was going up and it still is, but the only reason I sold is to buy more of ASTS. I've been buying this stock for quite some time, and if you're new, the company is basically trying to bring internet and mobile coverage to the whole world. Kind of like Starlink, but directly to phones. They have one satellite in orbit with which they have successfully completed 5G tests, a phone call and a video phone call. I have a whole separate video about how the technology works, so if you're interested I'll leave the link to the video in the description. Now they planned to launch 5 satellites in the first quarter of 2024, with which they would begin generating revenue, but they delayed it to the second quarter, which is why the stock dropped by quite a lot, but I bought more of it for another reason. At the same time they announced funding from AT&T, Google and Vodafone, which means that big companies also believe in this technology. But at the same time ASTS also also diluted shares to get more money, which is another reason why the stock was falling. Having said all that, this play is purely speculative and extremely risky, because the company's future pretty much relies on the launch of 5 satellites in Q2, so definitely not as safe of an investment as, let's say, Canadian Solar. The only reason I'm investing in it is because I strongly believe in their technology and business model, and because the reward to risk ratio is so high that I couldn't possibly pass up on this opportunity now that I'm young and can afford to lose it. On January the 22nd, I sold my whole stake in Gabarit to buy Walt Disney. Why? Because the stock was, in my opinion, trading way lower than it should, and the plan was formulating in my mind. You see, both Disney and PayPal were reporting earnings on the same day, February the 7th. And as ASTS continued falling and I spotted a great opportunity in Canadian Solar, I decided to hold my $275 of PayPal and $50 of Disney through the earnings, after which my positions would ideally jump up. I would immediately sell and buy either ASTS or Canadian Solar. Now, before we got to that crucial date, I also sold my whole stake in BHP Group and bought more of ASTS. And let me just tell you, I thought my plan was absolutely genius, because on February 7th ASTS dropped by another 10% to its lowest point ever, $2.59. I was even tempted to sell PayPal before the earnings, as I was already up by about 15% or $50 to buy ASTS, but I believed in my plan, and what a mistake that was. Right after Disney reported earnings, the stock jumped up, and then PayPal jumped up by like 10%, only for it to almost immediately drop by 10%. But okay, I said to myself, I can still sell both of these stocks to buy ASTS at its lowest point. But no, because on the same day ASTS announced a new contract award with US government for a prime contractor, which is obviously amazing, and that's why the stock instantly jumped up by 20%. So not only did I miss out on securing decent profits on PayPal, but I also missed the bottom on ASTS. Still, this government backing convinced me to sell Disney and PayPal for a small profit and buy ASTS. But because I also didn't want to pass up on Canadian Solar at those cheap prices, I sold my whole stake in Alphabet, IBM, Intel and Microsoft. And then on February 9th I sold another stock to buy more of it, as I plan to buy more and more of Canadian Solar. If you want to see what happened when I built an options trading bot and told it to YOLO, click on the video just popped up. And if you don't want to miss the next episode, subscribe, as you'll help me out a lot in reaching my goal of 1000 subscribers. And thanks for watching.